the financial world recently witnessed a significant development from the United States Federal Reserve. In September 2025, the Fed enacted its first interest rate cut in over a year. This decision marks a pivotal moment for the global economy. Specifically, the Federal Open Market Committee lowered the federal funds rate by 0.25 percentage points. This adjustment brought the target rate down to 4.75%. Such a move carries substantial implications for various economic participants. The initial impact of this rate cut has already begun to ripple across multiple sectors. We are observing effects in the stock market, the housing market, and the personal finances of millions. Understanding these changes is crucial for investors and the general public alike. The primary driving factor behind the Fed's decision was a noticeable slowdown in the job market and overall economic growth. Economic indicators had been signaling a cooling trend for several months. This prompted a reevaluation of monetary policy. Unemployment data played a critical role in this assessment. The national unemployment rate had reached 4.3%, a level that raised concerns about sustained economic momentum. This figure suggested that the labor market was losing some of its previous strength. The Federal Reserve operates under a dual mandate to achieve maximum employment and maintain price stability. The recent rate cut reflects the Fed's commitment to the employment aspect of this mandate. It aims to prevent further deterioration in job growth. The strategic goal of lowering rates is to stimulate borrowing, investment, and consumer spending. By making credit more affordable, the Fed hopes to inject new energy into economic activity. This can encourage businesses to expand and consumers to make larger purchases. However, this stimulation must be carefully managed to avoid triggering a resurgence of inflation. The Fed's challenge is to find the optimal balance. They aim to support growth without undermining the progress made on price stability. To understand the implications, it is essential to grasp the mechanics of a rate cut. The federal funds rate is the interest rate at which commercial banks lend and borrow their excess reserves from each other overnight. It serves as a benchmark for the broader economy. When the federal funds rate decreases, it tends to lower economy-wide borrowing costs. This transmission occurs as banks adjust their prime rates and other lending rates in response. Mortgages, car loans, and business credit all become potentially cheaper. It is important to note that the effects of a rate cut are neither instant nor uniform across all sectors. Some areas of the economy respond more quickly, while others experience a delayed or more nuanced impact. The transmission mechanism is complex and multifaceted. The stock market often experiences a potential boost following a rate cut. Cheaper borrowing costs can encourage companies to invest and expand, potentially leading to higher earnings. Additionally, lower bond yields can make equities more attractive by comparison. However, this positive outlook is tempered by the risk of stock market volatility. A rate cut can also signal a weakening economy, which could lead to suffering corporate earnings. Investors must weigh the stimulus against the underlying economic conditions. A bond market typically responds predictably to rate cuts. Bond prices usually rise as interest rates fall, making existing bonds with higher yields more valuable. This can generate capital gains for current bondholders. Furthermore, fear of a recession can lead investors to flock to safe haven assets like U.S. Treasuries. This increased demand further depresses bond yields. Such a flight to safety can reinforce the bond market's positive reaction to lower rates. The real estate market is one of the most sensitive sectors to interest rate changes. A rate cut creates the potential for cheaper mortgages, which can significantly boost home sales. Lower monthly payments can make homeownership more accessible to a wider demographic. Despite the potential for cheaper mortgages, the real estate market faces challenges. Buyer hesitation can persist if economic uncertainty remains high. There is also the potential for price adjustments in a slowing economy, which could offset some of the benefits of lower rates. Consumers generally stand to benefit from a rate cut in several ways. Lower credit card annual percentage rates can reduce the cost of revolving debt. cheaper loans for cars, personal expenses, and other purchases can also free up household budgets. However, there are also drawbacks for certain consumers. Savers, particularly those relying on high-yield savings accounts and certificates of deposit, may see reduced returns. Lower interest rates diminish the income generated from these conservative investments. The primary risk associated with a Federal Reserve rate cut is the potential for reigniting inflation. While the current economic slowdown justifies the move, an overly aggressive or ill-timed easing could reverse progress on price stability. This is a constant concern for policymakers. Inflationary triggers could emerge from various sources. If global supply chain issues resurface or energy prices spike unexpectedly, the economy could face renewed inflationary pressures. The Fed must remain vigilant against these external shocks. The Fed's challenge lies in balancing these inherent risks while navigating a delicate economic landscape. Their decisions require careful consideration of numerous data points and potential future scenarios. It is a complex act of economic stewardship. Investors will be closely monitoring several key indicators in the coming months. Upcoming jobs reports will provide crucial insights into the health of the labor market. Any signs of further weakening or unexpected strength will influence market sentiment. Inflation data will also be under close watch. Core inflation metrics, consumer price indices, and producer price indices will be scrutinized for any signs of acceleration. The Fed's future actions will heavily depend on these figures. Corporate earnings reports will provide a direct look into the profitability and health of businesses. Weak earnings could signal deeper economic troubles, even with lower interest rates. Strong earnings, conversely, could indicate resilience. The bond market reaction often provides early insights into the broader economic outlook. Changes in bond yields and the shape of the yield curve can signal investor expectations for future growth and inflation. It acts as a forward-looking barometer. A critical question for market participants is whether this rate cut is the beginning of a sustained easing cycle or merely a temporary adjustment. The Fed's forward guidance and subsequent economic data will clarify this trajectory. Understanding this distinction is vital for long-term planning. Ultimately, the Fed's recent move could signal the beginning of a new economic chapter. Alternatively, it might be a prelude to more significant changes as the economy adapts to evolving global and domestic conditions. The road ahead demands careful observation and informed analysis.